Hi, I'm Claire Smith, an Alternatives Director at Schroders, and I'm here to talk to you about our Specialist Private Equity Fund, which we think is a really interesting investment option in today's economic environment. So as you're all undoubtedly aware, we are in a pretty strange economic time with equity market valuations being at all-time highs, interest rates being at all-time lows, market volatility being quite high, and obviously we're seeing quite a shift in company dynamics, and we're entering what we're calling the fourth industrial revolution, which is an unprecedented speed of technology change. And we think an interesting opportunity is private equity. But before I delve into that, I just wanted to map out the global economy and how we see the world, because that really shapes the way we invest in private equity. So we've got regions like Japan and Europe where we're seeing an aging population and a reduction in working participants. We're then seeing other regions like the US where we're seeing an increase in working population, usually driven through immigration. Other regions like China and India, we're seeing a real increase in domestic middle class. Obviously, each country have fared COVID a little bit differently, and that has shaped our portfolio as well. But we're really seeing an increase in domestic middle class there, which is seeing a huge increase in growth in certain companies within those regions. So looking across the way we invest in private equity, I'll go from right to left. So venture capital is actually the team's first investment in private equity. So we've been investing in private equity for over 25 years. And our technology series is one of our longest running and best performing series. So this is a theme across all regions, whether it be a Silicon Valley startup, whether it be a new tech company in China, we still see venture capital opportunities around the world, and that will continue to play an important part in building our portfolios. Moving across to Asia, as I mentioned, we really see an increase in the domestic middle class, an increase in consumer spending, and we really want to capture that trajectory of growth through being at the forefront of technology, forefront of consumer companies, and really help capture that growth. When we move across to Europe and North America, there we segment the private equity market into size, because what we see is in the large buyout segment, there's a lot of demand, a lot of capital chasing few companies, and we're seeing what we think is a lot of price efficiency in that part of the market, and that's what we want to avoid. We prefer to stay in the small to mid-cap segment where the market is less efficient, you're able to find better value companies priced at more attractive multiples, and help transform those companies and grow them. And interestingly, in those segments of the market, our exit, once we acquire these smaller companies, is usually through selling to a larger private equity fund. That's converse to Asia and our venture series, where we're seeing a lot of exits through IPOs. So just moving on to why do we like that small to mid-cap segment in the private equity market in Europe and North America, we can see, statistically that there is a structural discount in the purchase price of these smaller companies. So we define a small company as being less than $100 million or euros of enterprise value, and a large company as being greater than $500 million or euros. And what you can see across the two charts, plotting Europe and the US, is there is that structural discount in that segment of around 3 times multiple. We're also starting to see a slight drift upwards, as I mentioned, in that larger buyout segment, where there is a bit more demand, a bit more price efficiency. So we really prefer to be in that smaller segment. In the smaller segment, we also see a reduction in leverage. So smaller companies typically have a lot lower leverage, which we prefer because we really like to drive performance through company improvement rather than through leverage. And the other interesting statistic about the smaller segment in Europe and North America is 60 to 70% of the companies we acquire are previously family-owned businesses. They've been handed down a few generations. Suddenly the latest generation doesn't want to run the old factory anymore. They want to go off and have a more exciting career. So private equity can come in, help take that company, implement capital, implement strategic decisions to help them grow, whether it be vertically, horizontally, operational improvements, whatever it may be. So there's a really great part of the market to capture there where you can deliver a lot of valuation increases through just improving the company, a fresh set of eyes over a company that might not have had a fresh set of eyes on them over a few generations. Moving on to the performance of this particular fund. So we launched this strategy in Luxembourg in US dollars in September 2019. It was an interesting time to be launching a private equity strategy. It went well for the first few months and then February 2020, we obviously put all the deals in the pipeline on hold because we realised there was something very unusual going on in the world. We have an Australian feeder fund denominated in Australian dollars, and we launched that in March 2020. So the only difference between the two vehicles is currency. Unfortunately, we struck the first Australian dollar NAV when the Aussie dollar was 66 cents against the US dollar, so it has fought upwards battle in terms of currency. But nonetheless, both funds have performed extremely well. So in the US dollar share class, we do have about 17 months of performance, and we've managed to return a 45% return during that period. The drawdown during COVID was very minimal, only around 3%. It's because we really focus on sectors like healthcare, technology. Even in the consumer space, we try to focus on non-cyclical companies. So that really minimised that drawdown during COVID. And then we've seen some very strong performance, particularly strong performance in December. We had a company that IPO'd to a great deal of success. It was a relatively large position in the portfolio. The company went up 5 times from the point we acquired it. So that's driven a lot of that performance in December. But nonetheless, even when you strip that IPO performance out, in US dollars, we've returned about 16% in the course of 2020, which is really on track with what this fund is trying to deliver. So we're really trying to deliver around 10 to 12% net of fees, net of cash drag as well, in a semi-liquid format to investors. So we understand that there have been a lot of historic impediments to investing in private equity. There's been high minimum investments, so this fund is designed to both reduce the minimum, and also we've been accepted onto a lot of the major wrap platforms, which makes it a really accessible investment opportunity to a much broader range of clients. The second impediment that a lot of people have fed back is, daunting for private equity, is traditional private equity funds have a very long lock-up period. This one, you have the ability to withdraw your capital, giving a 1-quarter notice period. We do then we do highlight this as a key risk of the fund because we value all the companies within the fund on a monthly basis using fundamental valuation techniques, and that takes around a 1-month period for us to produce those valuations. So the fastest you can get your money out is 4 months. So we do make sure we're very upfront about that, as it is a lot less liquid obviously than traditional liquid listed equity funds. However, it's a lot more liquid than what you might have traditionally seen in the private equity space, and it does give you that ability to access capital should your personal circumstances change. Should you wish to change the weighting of your portfolio, you can access your capital on a periodic basis. The third real impediment that we've heard about private equity investing is there's a lack of understanding, a lack of transparency in the market. So we really are trying to make this fund a lot more transparent. We're trying to give a lot more information on the companies we're investing in, the strategies we invest into. We report the performance on a monthly basis, and we give a rationale for what's happened within the underlying companies to try to really give people more flavour for what's going on, why we're making the investment decisions we're making, and why we see value in this part of the market. And then the fourth impediment to private equity investing has been it's traditionally been an expensive and very complex fee structure. Private equity is still more expensive than investing in listed equities, obviously, because listed equities, you can sit behind a Bloomberg terminal and buy and sell companies. With private equity, you are outsourcing privately held companies. There's a multi-month due diligence process that has to be undertaken before acquiring a company. You are, usually a seat on the board, a seat on the management company, really trying to help drive the transformation through that before picking the optimal time to exit. So it is a different pricing mechanism, no doubt, but we've really tried to help make this as clear and transparent and fee efficient as possible by charging a relatively low management fee versus our peers, and we've decided, importantly, to waive all the performance fees. So performance fees in semi-liquid structures can be quite challenging to implement. We debated a lot internally and decided we would just waive it all together to really keep it very clear, very transparent, and really make it more accessible to a broader range of investors. So if you'd like some more information on the fund, we've got a website you're welcome to visit and some contact details for our team below. So we'd love to have a further discussion on the fund and its attributes. Thank you.